Alright, what I'm going to be covering right now is some business organization. Now, keep in mind, and I mentioned this earlier, that I only want you to watch me and go through the concepts of all this and listen. When you get to your highlight sheets and the questions from the manual, it'll take you to where these things are found in your actual books. But again, this is just understanding business concepts. So watch and listen, and then when you get into your books, everything's going to make sense for you. So the first thing we want to talk about is business organization. Now, typically we see that in three different types of business structures. One is a sole proprietorship. You just want to do it yourself and everything stays in your name. And that's a great way to do it, but unfortunately you have the unlimited personal liability there. Another one is a partnership. Well, the partnership still leaves you with that unlimited personal liability. If something gets sued, they can come back on you. And now you're, have to be cautious of the decisions of your partner. And there's the corporation. Or even an LLC, which you see a lot of people, setting up. So you can read this. A sole proprietorship is where a person does business in his or her own name. And that's just what it is. You're doing everything as yourself. So the advantages, it's quick and easy to set up. Owner has complete control over all decisions. They're responsible for all decisions. Ownership of the business can be freely transferred. Ownership of the business, owners may sell or alter any part of the business or business venture at his or her whim. You don't have to ask permission from anybody. Now, the disadvantage is the owner has the unlimited personal liability, and that's what scares most people about a sole proprietorship. It's that, and the only way you can qualify for an election to be exempt under workers' comp is you have to be one of the three corporate officers or three members of an LLC in order to qualify. So a sole proprietorship no longer qualifies. Business will be terminated upon the owner's death. You die, it dies. Owner's personal credit and property is used as security for business loans. So, the construction company folds, but they're still going to come to you looking for the money. And the business profits are taxed as income to the owner. And we'll talk about that later on. Sole proprietors quite often mix personal and business funds. It's very easy to commingle funds when you get a bulk payment coming in and you have your, business checkbook open and there's money in there. It's real tempting. Let me just write the check out of the book, and it's, it's your company, it's your checkbook, it's your money. But, you should always avoid, mixing the personal and business funds. Now, there's an example. A sole proprietorship started a business January 1st. The business was formed as follows, and it shows you January we had a profit of $1,500, February we took a loss of $700, March a loss, and then it goes down the list all the way through the year, leaving us a positive total of $7,910. What dollar amount would be used to compute the tax liability for the sole proprietor who began the business if the business was sold to another individual on May 1st? Okay. So we started the business in January, and then we're going to sell it. So if I'm going to sell it in May, all I need to add up is the first 4 months of the year. January, February, March, and April. And of course, 2 of those was in the negatives. So the $2,700 is the net profit. That's taxable income to the sole proprietor. So you're going to have to pay taxes on the $2,700. Now, in a partnership, now again, we've all done it, we've all seen it. 2 or more people join together and form a partnership. Now there's articles of partnerships. People take it beyond the historical, let's shake hands, we'll be partners, everything's going to be fair. Well, over the years you found out that may not work very well, that you need to go ahead and get everything in writing by setting up an articles of incorporation, but that puts you and the other person as basically a team or a partnership, just what it says. Now again, you're going to have to, pay taxes on that. And here's an example that I put in here for you. Now you can read this if you need to. But here's an example problem. A partnership is made up of 3 partners. Partner A contributed cash of $15,000. Okay, partner B contributed cash of $26,000, and partner C threw in $19,000. So we have a total capital investment of $60,000 in the partnership. Now the annual profit to be distributed has to be determined to be $76,000 by the accountant. Now we're looking at partner A now. Would receive blank if the profit payment is based on equal distribution. Well, I'm sure that B and C want it done at equal distribution, but since partner A contributed the least, he probably doesn't want that, but we're going to do it that way. And look at the answer down here. All we had to do was take the $76,000 and divide it by 3, and that's $25,333.33. Okay, that's equal distribution, which means he put in the least, but he's getting the same amount as B and C. Now, basically the same information, $76,000 per the accountant. Partner A would receive how much if the profit payment is based on the percentage of investment. Now, this is what B and C above would want. We're taking the $15,000 which he contributed into the partnership and dividing it by the total, which was 60. That tells us that 25% of the investment was his. If so, then he needs to receive 25% of the profits. So if I take 25% of $76,000, that means instead of getting $25,000 and something, he's only going to get $19,000. Okay, as 25% of his initial investment. Now the advantages of a partnership, your financial resources can be pooled, startup costs are low, the ability to raise outside capital is increased, daily responsibility and management can be shared among the partners, and taxation is on each partner, not the partnership. Okay, so that's an advantage. Well, the disadvantages. General partners have unlimited personal liability, so it doesn't mean the license holder does, it means anyone in a partnership does. Unlimited personal liability. And the way it works is, if the 3 partners are there, and it's $100,000, they don't split it up and go after each one of them for their third. They simply go after the one with the most money. That partner would pay the total, and then it would be up to them to collect the money back from the other partners. Liability is called joint and several. For instance, if a general partner is sued, okay, the person whom the lawsuit was awarded can collect the money from all the damages from one partner. So again, that's just what I just said. The partnership is terminated upon the death of any of the partners. So as soon as one of them dies, it dissolves, or by withdrawal of a partner or bankruptcy of the partner. Partnership interest is non-transferable without consent of all partners. So everyone has to agree to it. You have no choice. Each partner can bind the other partners without the consent of the other partners in the normal case, in the normal course of business. So any decisions your partners should make binds you to it. So if you're the license holder, then you're definitely in trouble. You're responsible for all their decisions. Now, it can be made up of 3 different partners. General partner is me and you join together. We're each doing the work. We're sharing the profits and everything's good. And, we have unlimited personal liability. The limited partner is, once I make my initial investment as a limited partner, as long as I just make the investment, I don't have any involvement in the company, I don't show direction or advice, and the company gets sued, the most they could take from me, the limited partner, would be my initial investment, whatever that was. But they cannot come after me for any more. As in a general partner, they could come after you for the full amount. A limited partner, they can only take the initial investment. And a subpartner is someone who forms an agreement with a general partner to oversee all portions of the general partner's business activity within a partnership. The subpartner is not a member of the partnership and has no voice or vote in the management of the partnership. Okay, and that does make sense, and we do see that occasionally. Now, here's another example for you. Smith is a general partner in X, Y, and Z partnership, having a total of 4 partners. The maximum personal liability of Smith to unpaid creditors would be blank if the partnership dissolved, having unpaid creditors totaling $17,000. Partnership's profit and losses were allocated proportional to an investment, and Smith's percentage of investment is 18%. Well, once you saw that word general partner, nothing else really matters. At that point, they can come after one individual, partner A, even though he only has 18% of the business. They could have him pay the full $17,000 and then simply collect the money back from the others. So partner A is on the hook for everything. Okay. And here's another one to keep it going. The partnership dissolved, leaving debts of $170,000. The maximum liability of a limited partner to the current creditors would be blank if the limited partner's investment was $70,000. Now here's a limited partner. Now he doesn't get involved in the day-to-day operations of the company itself. Okay. Now his initial investment was $70,000. So the maximum liability of the limited partner to the current creditors would be blank. Now it's already been dissolved and it left debts of $170,000. But the limited partner is going to be, well, again, the limited partner is going to not get his $70,000 back. But what he owes the current creditors is nothing. They can't come after him for anything else. Now, if he was a general partner, they could come after him for the full amount. Now, the corporation is the next step and way that a lot of contractors go. And it's a couple of reasons why we do this. One is our accountants tell us they can save us money if we set up a corporation and funnel everything through the corporation and run it correctly. Then you have your attorneys are setting it up. They're looking at it from a legal standpoint of how can they best protect you in case of a lawsuit. And of course, if everything is being worked correctly and the corporation is sued, it will stop at that level. They will not come to any of the officers and attach it to them. That's assuming everything was done correctly. Now, if they catch you commingling of funds or improper, signature or, a bunch of different reasons, they can pierce the corporation and then come after you personally. Okay? But it's our best bet. Now, for private, the stocks are not publicly sold or traded. In a public corporation, these stocks of the corporation are openly traded among the general public, and then you have a non-for-profit or not-for-profit. Okay, this corporation must be retained all of its profits. Okay, it has to retain everything. Any profits of the corporation may make cannot be distributed back to the shareholders in the form of a dividend. Okay, managing owners and shareholders can be compensated for their services, but the corporation's surplus funds cannot be returned to the shareholders as a dividend. So I can always have a not-for-profit corporation set up and just make sure I pay myself, a good salary, and then I don't withdraw any dividends. And look at some of the non-for-profit corporations out there and see what their CEOs and everyone is getting paid. Okay, the profits. Stockholders, shareholders are the owners of the corporation. Shareholders, larger corporations generally elect a board of directors to run the corporation. Stockholders are paid dividends on the profits. Okay. So a contractor owns 26 out of 100 shares of a corporate stock. The contractor's annual dividend would be blank if the corporation was distributing annual profits of $48,000. So he owns 26 out of 100 shares of the corporate stock. That makes it easy for me to do as far as the math goes, because 26 divided by 100 is 26%, okay, or 0.26. So 26% of the profits is mine, of the 48,000, that is. So if I take 26% of $48,000, that's going to give me $12,480 is what my percentage of it is. Now, again, at any point, if you need to stop the video, just go ahead and hit the stop button, work the problem on your own, and then start it up again. Advantages of a corporation: limited liability of owners. One of the ways we do this in the first place. Greater ease of raising capital. Business continuation in the event of the death of an owner. The corporation considered a separate and distinct entity from the owner. Now that's an important sentence there that you want to catch up or look at, because we're going to come back and talk about it. Now, disadvantages of a corporation: unless it's a subchapter S, you have a good probability of double taxation. Taxes paid on the profit made by the corporation, and tax paid to the shareholders on dividends paid by the corporation. So it's a good possibility. Formality and cost to maintain a corporation and corporate books, okay, is always the disadvantages of setting up a corporation. But it does limit your liability, so that's one of the better things. Now, most of us are at a subchapter S corporation. With a corporation, double taxation may occur. First, the corporation pays tax on any corporate profits made. Then the shareholders pay personal income tax on the dividends received. Therefore, you get that double taxation. With this type of corporation, it allows where you don't pay the corporate tax on the profits, so you only get taxed a single time instead of the double tax. Okay, here's another example for us. What business structure allows a contractor to operate a corporation yet pay taxes as an individual? Well, we just talked about that. It's the sole proprietorship. Okay, it's the only one that will allow us to do that. All right, here's another one. John wants to set up a small corporation called John's Remodeling, Inc. John wants to capitalize on the corporation by issuing and purchasing, 100 shares of stocks at $100 per share. Now, the corporate offices are to be the president, vice president, secretary, and treasurer. John wants to own all the stock and hold all the offices. Which of the following is the most correct statement about John? John can either own all the stock or hold all the offices, but not both of them. John can own all the stock, but then could only hold one of the offices. John can hold all the offices, but he would have to have at least 50 shares of the stock in the corporation's treasury. John can own all the stock and hold all the offices, but it's a good idea not to for management and legal reasons. And of course, the answer there is D. Yes, you can. You can own all the stock and own all the offices. Now, there is legal and management reasons why they suggest you not do that, but the question was, could you? So the answer to that is yes. Now, under 1.5, it's control of the business. As a sole proprietorship, you have absolute authority. It's your company, your business. Partnership, control of the business is shared with your partners, who may lead to disputes. Okay, and again, a lot of you have been in a partnership and you understand that. A joint venture is the same thing as a partnership. It is a legal and distinct entity from the owner. And then you have the corporation or S corp. Control depends upon the ownership. In other words, 51% of the stock ownership or control means that you are able to make policy decisions. And what this is going to do is go through the dissolution of a business organization. The voluntary dissolution or termination of a business organization must be considered, with as much thought and planning as is devoted to the initial organization of the business plan. The method, the manner, and timing of the business termination may have a significant tax consequences. Of the major forms of business organizations discussed earlier in this chapter, the dissolution of a partnership and corporations may be somewhat complex and would therefore be given attention herein. A partnership dissolution or termination, when a partnership comes to the end, there are basically 3 steps which it goes through. It goes through dissolution, winding up, and termination, which all seem to be on the test. And it's also in your book. So once again, you can always go back to your own book and go over the dissolution of a partnership and so on. A partnership is also dissolved by any event that makes it unlawful for a business or partnership to be carried on, for other members to carry on as a partnership. The death of a partner, it dies, you die. Bankruptcy of any partner or the partnership. A court decree under the Partnership Act. You can dissolve a partnership by any one of those methods. And I'm not going to spend too much time on this. It's not tested on, and none of us really want to think about a dissolution or liquidation of our business yet. We got to be in business for a while before we think about that. So I'm just going to blow through these. Now, they're in the books, and you can always go back and read them after you pass the test, but don't spend much time on them. Now, I'm going to go to the business plan here. Now, this is pretty important, and unfortunately, a lot of people don't do it when they go to set up a company. It's important to sit down and actually, look at this, and list out, write it out on a sheet of paper, the type of construction that you will be doing. Are you going to do new homes, remodels, additions? It depends, if you're going to want to do commercial, you're going to have a lot more of a net worth and, cash in the bank than if you're just going out and start doing, repairs or remodeling services. So you need to think about that. What are you going to do when you go into business? The demand or need for your market services within the area. Do they need more? Or you might have to work outside your service area, or, change and adopt. Who will do the work you require? You're going to do it yourself. You're going to hire employees. What will be the long-term and short-term financial needs of the company? What's the assets and liabilities are, and how much profit will you need to meet the expenses you have as your company grows? Now, those are all real important things that you need to think about, even before you get your license. Once you have a plan structure decided and you have determined that your business plan can be successful, you'll then need to consider a final checklist before going into business. Do I have the financial resources to start a business? How is my personal liability affected by my choice of the business structure? Sole proprietorship, corporation, limited liability. Can I change the scope of my business services in the future? Has the business structure I decided on considering the possibility of future events, such as, what if someone wants to come into the business at a later date? How will a business structure accommodate a change in my potential earnings? How would this business be left to my family or heirs? What if someone wants to buy my business in the future? What are the differences in the tax requirements and regulatory requirements for the business structure I decide upon? What is the purpose of obtaining financial financing for the business structure I've chosen? What will be out of my pocket expense right now to set up the business, and will the expense because of a burden on my family or financial position immediately. So there are all good choices and questions that you would need to make. Managing the business, there's a few steps here. There's planning, and general planning means anticipated problems and taking advantage of business opportunities. So you got to plan. Then you have to organize. Organize is closely related to planning, but involves identifying, prioritizing, and assigning key activities and responsibilities to the proper personnel. Then there's directing. As the owner or manager of the business, you will need to get the work done by employees. You will need to recognize that individual employees respond differently to various types of incentives and praises. Successful managers knows that most employees produce much better if they feel appreciated and are making a contribution to the wealth and growth of the business. A good manager will always appeal to an employee's sense of job satisfaction and well-being. You're controlling. Controlling is simply the act of making sure that the results you originally planned have not differed. Standardizing. Standardizing is exactly what the name implies. It's developing a standard and similar way of doing all repetitive operations. For instance, payroll records should be on a standardized form. Job recap, sheets should be on a standardized form. The way incoming calls, sales, leads, and follow-ups are handled should all be handled in a standardized method. And then assigning. Assigning is simply delegating the work of your business organization out to the different employees that you have, looking at their strengths and weaknesses. And lastly is communicating. Now, the communication is the key to a successful company. There is nothing more frustrating to management and employees than misunderstood direction. A good communication program will require that whenever management makes a decision, it is given to employees clearly and concisely, and communication goes the other way. That is, management always listens to what the employees are saying clearly and concisely about their problems or grievances with the work. For if the two do not work in harmony, the company cannot survive.